Hello everyone, welcome back. I got some really good ones for you today on this Sunday, March 12th, 2023. Normally I like to keep the Sabbath holy, use it as a day of worship, rest, refit, hang out with friends and family, worship God, all good things. But today I have a bit of time-sensitive information I needed to pass along to you guys. So it's going to be a pretty quick video, but I did want to address the potential banking contagion forming right now around Silicon Valley Bank. On Thursday alone, we saw $40 billion get extracted from that bank. So a bank run, not your traditional bank run where mom and pops try to run down to the bank and get all their money out before the bank closes that day. It's a lot of venture capitalists, tech entrepreneurs with over $250,000 in deposits. The FDIC is not going to insure them beyond that amount. So a lot of big money showing up at the bank trying to get all of it out as quickly as they could. You had Peter Thiel, a venture capitalist, tech guy, kind of calling up his homies saying, get your money out, get your money out. What happened? Well, Silicon Valley Bank drawing a lot of interest this last decade as the tech bubble just proliferated, and we saw just all these different companies with tech ideas that were maybe a little bit less conventional than, say, JP Morgan wanted to play with. So Silicon Valley Bank kind of filled that role, working with a lot of venture capitalists and tech entrepreneurs. They were bringing in all this money. They were sitting on like 80 or 90 billion in cash at one point and decided, hey, we need to put this into some conservative investments so we're at least making something on it. They bought a mix of US treasuries and mortgage-backed securities. But the problem is they bought these quote unquote conservative investments when the yields were really low. So if the yields are really low and yields and bond prices are inverse, it means they bought a bunch of bonds when the value of those bonds were really high. So even though they bought a conservative investment, they didn't take an exorbitant amount of leveraged risk and have it blow up in their face. They just bought a bunch of bonds and treasuries. But the problem is those yields were very low. And today, only a couple years later, they completely underestimated how quickly the Fed and how aggressively the Fed was going to raise interest rates. Those yields are much higher. So yields and rates are much higher now, putting the value of those bonds they bought a couple years ago much lower. So they took like a few $1 billion drawdown on those bonds and then started to sell stock and try to raise more capital. And this kind of spooked those venture capitalists and tech entrepreneurs into wanting to, withdraw their deposits. Next thing you know, everybody is withdrawing at the same time. So it's not like they took all that 80, 90 billion in cash and did something very silly or stupid or illegal with it. It's that they bought a bunch of conservative investments at a horrible time, took a drawdown on those conservative investments, created a little, $2-3 billion black hole they needed to fill up. And as soon as they start trying to fill up that hole and paper over those losses, it's too late. Everybody's already making for the door. So a bit of a miscalculation on Silicon Valley Bank's part with regard to how quickly interest rates and bond yields were going to rise. And that kind of left them in a pretty horrible position, because if they had just bought all these conservative investments today, the yields would be much higher. So yeah, they bought a bunch of bonds, mortgage-backed securities and US treasuries. They took a few $1 billion drawdown on those bonds because interest rates and yields moved up a lot quicker than they were ready for. That left them with a problem they needed to paper over. But before they could paper over the problem or raise more money, everybody just bounced. Now, everyone's wondering, well, is this going to, create a domino effect through the financial system? Silicon Valley Bank was the 16th largest bank, so, exponentially smaller than, say, JP Morgan or Bank of America, but not super tiny, perhaps big enough to really create a problem. We have these other like regional banks like Western Bank Corp drawing down 20% on Friday. So some of these smaller banks are getting beaten up pretty good. And, you know, the larger ones are taking a hit too. So the financials across the board are starting to show signs of contagion from this Silicon Valley Bank fallout. But I'm here to tell you that the plunge protection team is probably going to be out in force tomorrow. So the Federal Reserve is going to be doing everything in their power to keep this from spreading. And they're going to do anything they can to engender confidence in the financial system while they do it. So I would anticipate a speech from Powell or Yellen or one of these Fed governors as early as tomorrow regarding what they can do to kind of contain this. Personally, I'm bullish, and that might be pretty contrarian. Look, I'm not a permabull, okay? I don't want you guys to think every time I come out here I'm just bullish. I'm just hyper bullish all the time. But what do you think's going to happen now? Do you think the Fed is going to raise interest rates 75 basis points or 50 basis points at the next meeting? I doubt it. I'm sure that the market is already pricing in less rate hikes from the Federal Reserve going forward, and ultimately that's bullish. If the Fed had, you know, 2 more rate hikes planned for us at 50 basis points each, and now it's only 1 rate hike of 25 basis points planned for us because they need to begin to stimulate and keep the banking system propped up. Well, taking interest rate hikes off the table going forward is going to be very bullish for risk. I mean, I'm thinking that bond yields are going to begin to fall. The dollar is going to begin to fall. Interest rate hike expectations are going to be tamped down. We're going to see smaller rate hikes going forward, and ultimately that's going to be positive for inflation, negative for the value of the dollar, and that stands to reason it could push, you know, risk assets higher. So we're going to have to see, you know, these deflation are very quick and very nasty, so maybe tomorrow we do see a gap down in the Dow Jones by like 1,500 points or something like that. But we could also shoot up 1,500 points. It really depends on how quickly the Fed shows up to put out this fire, the plunge protection shows up, the Treasury shows up. Funny thing, I asked ChatGPT last night to simulate a conversation between Larry Fink of BlackRock, Jack Bogle of Vanguard, Jerome Powell of the Fed, Janet Yellen of the Treasury. I told the ChatGPT to simulate a debate amongst themselves about what to do for a bank run. And ChatGPT tends to agree with me. So the way that the conversation came out is, you know, Yellen and Powell were quick to come to the rescue. And I think we're going to see that this week. By come to the rescue, it's going to hurt the dollar. It's going to hurt wage earners. It's going to hurt and stoke inflation more. But could it rescue the financial system, and could it keep risk asset prices propped up if the Fed runs out on, you know, Monday morning and starts telling everyone, don't worry, we're going to handle this. We're going to cut interest rates. We're going to paper over this bank's losses. You know, I see all of that coming. So you want to kind of try to stay one step ahead. Like if we gap down 1,500 points on the Dow tomorrow and then you sell all your bank stocks, there's a very high probability you have just sold the bottom, because what we're doing right now with these forward-looking markets is waiting to see what the Fed does about it. And I highly doubt the Fed's going to come out tomorrow and say, let Silicon Valley Bank fail, let that, you know, spread through the financial system, let all of them fail, and then maybe we'll think about it. We're past that. Silicon Valley Bank's already imploded. You know, after having watched the tape for 15 years, I would say I got a pretty good idea of what our policymakers are going to do starting, you know, today. They're probably having an emergency meeting right now, and they're going to be coming out tomorrow talking about taking interest rate hikes off the table, plugging the hole, stopping the contagion, having the FDIC go in and try to insure as many of these deposits as they can. And look, this is all dollar negative, okay? So, you know, call me crazy, but all this is doing is telling me that the Fed has finally broken something. The Fed wanted to keep raising interest rates in their quest to fight inflation until they broke something, and something has finally broke. So the Fed jacking up interest rates and bond yields so aggressively, so quickly, has finally broken the first bank on the leaderboard. The 16th largest bank can't handle the higher interest rates, higher yields, even given their conservative allocation to bonds, and things are starting to break. Now that the Fed has broken something, I think the Fed's going to start backpedaling and becoming more bullish. So we're just going to have to see, but never rattle. Don't worry. Generally, when you start really freaking out like the media wants you to, that's at the absolute worst time to be freaking out. And generally, the book says buy. You know, the book says generally you're closer to a floor than a top. So we'll just have to see. We could continue to crash. This contagion could continue to spread through the week. I'm curious to see where the bottom is. I'm curious to see at what point the Fed runs in and patches the hole. And we're just going to have to see, all right? So that's really all I got for you today. I didn't want to sit on this. I didn't want to bring you guys a video on this on Wednesday. I want to keep you guys ahead, and, you know, we're just going to have to see how tomorrow goes, but never rattle. Never rattle. Don't get too freaked out. Don't get too sucked into the hype. Try to resist, you know, thinking, oh no, a banking contagion, ergo massive deflation, everything crashes. Try to resist that thinking, because we don't have a wealth-based system anymore. It's a debt-based monetary system. So any and every excuse for the powers that be to come out and weaken the dollar and keep the current regime in power and solvent, that's ultimately what the Fed and the Treasury are going to shoot for. So we're just going to have to see. Pretty crazy. And that's really all I got for you for right now. Until next time.